Welcome back to the Hemlane Hustle, the podcast where we dive into everything real estate, property management, and building long-term wealth related. Today, I am so excited to share an incredible guest who truly needs no introduction in the real estate investing world, Jason Hartman. Jason is a seasoned investor, entrepreneur, and founder of the Creating Wealth Show, where he's helped thousands of people understand how to leverage real estate for financial freedom. With decades of experience and an uncanny ability to break down complex economic trends, which I very much appreciate, Jason, he has been on the forefront of predicting market shifts and uncovering opportunities that most real estate investors overlook. Today, we're going to talk about some of the hottest topics in real estate, why home prices keep rising, the impact of inflation, and whether renting might actually be a smarter move in today's economy. Jason, welcome to the show.
Thank you, Dana. It's great to be here. And, it seems like we probably should have done a show together a long time ago, but we're finally doing it. So that's wonderful.
Exactly. And it's a very interesting time right now because you had a recent video which really stuck with me. It was called The Shocking Reason Housing Prices Keep Going Up. And I think that there's a lot of people wondering, should I get into real estate investing now? Prices are high. Now we have interest rates higher than we had seen the 10 years prior. Can you elaborate on the primary reasons behind the continuous rise in housing prices?
Yeah, and for those watching on video, I'm going to just share my screen and show you a couple of slides. For those listening in audio only, I will explain them, but if you have the benefit of the video, it might be helpful. So I've been helping investors buy properties nationwide for the last 21 years. And one of the things that amazed me, Dana, is how all of the experts got it wrong. Virtually all of them got it wrong. And I'm going to take some credit here because I got it right. And so here's what happened. In the sort of at the tail end of COVID, right before, right after that, we saw interest rates increase dramatically, some of the most dramatic increases in history. And we were in a situation at that time where we were used to seeing over 5 million transactions per year in the real estate market. And of course, transaction volume dropped dramatically, and that's why all of your friends who are in real estate, the real estate agents, the title companies, the mortgage companies, they're all singing the blues. They're complaining like crazy. And don't let me forget the mortgage people. They're definitely complaining because they had such an amazing boom. And so what happened is transaction volume went way down. And why did we see, we need to separate that transaction volume is not sales prices. Those are two completely different concepts. And so the reason volume went down is because of the lock-in effect, which now everybody has heard of. So much of the country has these ultra cheap mortgages. And here's an example. We've got about 65% of the country having a mortgage payment of 4% or lower, or a mortgage interest rate, sorry. And then about a quarter of the country, about 25% give or take, at 3% or lower. And what all of the experts confused is they said rates went way up, housing affordability went way down. That's all true. And so that usually means that nobody can afford to buy, so demand has been destroyed. And when there's demand destruction, you typically see sellers continuing to put their house on the market, so inventory levels would go up. Inventory levels only went up slightly. And inventory is still very low because the experts confused the new entrants into the market, the new buyers, with the existing homeowners that control the inventory. And that is a major mistake. The people moving into the market, the new entrants, their deal isn't very good. Everybody's complaining about terrible housing affordability. We all know that. But the existing owners are in an extremely good position where their houses are super affordable. And so they don't want to give up their great deal. And this has been referred to since as the lock-in effect. But I was talking about this way before anybody even developed that term. And so here's what we have now. We have about 135, 140 million properties in the country. And the vast majority of them either bought their home or refinanced their home in this era when the national payment to income ratio was very desirable and very good. The people entering the market were subject to this kind of thing, and this was not so good. So the experts forgot about who controls the inventory, and they were only focused, and they would have been right in the past in other market cycles that we've been through, but they were wrong this time because they didn't look at the huge benefit of the people that control the existing inventory. And they just don't want to give up their incredibly cheap mortgages.
Yeah. And I mean, that's something that we have here in the US that not every country has, where you can
Right.
lock in a 30-year mortgage rate. What are your predictions for the future? And I mean, one of the first things that comes to mind is like the rise of the accidental landlord, because someone says, now my mortgage is an asset. I'm going to hold on to this. But what are some of the predictions, and when do we start seeing those who had these low interest rates sell? Would we have to see interest rates go down below 5, below 4%, or what are you thinking is in our future in the next 1, 2, up to 5 years?
Right. That's a great question, and I'll kind of get to that in a roundabout way. Okay.
Okay.
So first off, everybody should be looking at the existing market like this. Okay. It would be like going to the grocery store and half of the shelves being empty. The shelves represent the inventory of housing for sale. Our inventory levels during the COVID era, when the market was just nuts, okay? I mean, there were, zillions of offers on every property. The minute it came on the market, it was very constricted. We had about 240,000 homes on the market at the lowest point of inventory during the COVID era. And then we now have just under 700,000 homes for sale in the country. But the question is, and this is a saying that people have attributed to me, but I certainly didn't invent this saying, and it's, I think, life's most important question: compared to what? To understand anything, we must be able to compare it to something else. That's the way human beings think. That's the way they understand the world, by comparison. And compared to what? Is that the inventory now is less than half of normal. Normally, in a normal market, we would have about 1.4 million homes for sale. We have less than 700,000 homes for sale now. So that's the first thing we need to understand. Inventory is very low. It's certainly not the lowest it's ever been. It's much higher than it was during the absolutely psychotic time during the COVID era, but it is still historically very low. And as such, the one thing I always say on my show, Dana, is that if you want to have a real estate crash, if you want to see a big correction in prices, there is one ingredient that is absolutely mandatory. You cannot have a crash without this one ingredient. And here it is. You must have millions and millions of distressed homeowners who become millions of distressed home sellers.
Mm-hmm.
Now we have the complete opposite of that.
Opposite.
Yeah.
Yeah.
And a lot of people have trolled me on YouTube saying I'm wrong about the market. And they said that, oh, Jason is missing the elephant in the room. And here's their elephant. They said, well, the elephant in the room is that we're going to enter a recession. Now, they've been saying this for several years, and we still haven't, okay?
Yeah.
But, maybe we will, who knows? We're going to enter a recession, and there's going to be massive layoffs. And unemployment is the elephant in the room. So you know what I did? I went to one of our mortgage people that we've worked with for many, many years, and I had a Zoom meeting with him, and I said, I want you to share your screen, and I want you to open the underwriting software that you use to underwrite and approve loans and to qualify people. And before that, I did a bunch of research, and these numbers do vary, on how much people would get on unemployment insurance from the government.
Okay.
Okay. And so what I did here in this study is I took the amount people would receive for 6 months of unemployment insurance, which, by the way, during any crisis is usually extended. Now it's 6 months, right? So if they got laid off and they had sort of a typical car payment and maybe some credit card debt and maybe a little student loan, right? Or little, it's not little, but a student loan, right? And based on their unemployment income and their debt, we develop what we call a DTI ratio, a debt to income ratio, that everybody in the real estate and mortgage industry knows that terminology. So based on their DTI, would they qualify for the loan they already have? Not a new loan, because no lender will give you a loan if you're unemployed, right?
Yep.
But they already have a loan. They don't need a loan, okay? They have a loan on their existing home, right? And the answer is they would qualify for the mortgage they already have on unemployment insurance, okay?
Yeah.
So they could get laid off. And even with a layoff, with a massive round of layoffs, this would not cause major distress in the real estate market. So the experts miss this stuff. You got to peel back the layers to really understand what's happening. What are my predictions? Well, let me tell you something, Dana. In the last 21 years that my company, Empowered Investor, has been helping investors buy properties nationwide, I don't think, and I've been podcasting for 21 years, so you can go back and listen to my old shows that are date stamped and listen to what I was saying 21 years ago, and you can see if I was right or wrong, okay? The record is there. Right? I can't cheat on this record, right? I can't, rephrase things or anything. It's all out there, okay? And you'll find that I've been right pretty much all the time. I've only been wrong about one major prediction, and that is interest rates. Interest rates are extremely hard to predict, and I've given up on interest rates. But my market predictions in terms of prices and rents, they've all pretty much come true, okay? So what do I say today? This is one of the hardest years ever to predict. There are just so many wild cards, Dana. We don't know what our new administration is going to do. It is just a lot of guessing, okay? And we know how erratic Trump can be, okay? And I think what he's doing is going to be fantastic for the country. Long term, everything he's doing is going to be really good for all of us that are here legally, okay? I mean, look, if you're an illegal and you're getting deported, it's not so great for you. But for Americans, it's going to be great, okay? But it is not going to be without some bumps in the road and some pain along the way. And that'll probably be pretty short term. But here's why I say that. I mean, look, if you take 4, 5, or 6 million people out of an economy, that's going to make a dent, okay? A lot of these illegals work. They have jobs, okay? And not all of them, of course. They are a net cost to taxpayers. But the problem with that equation is that they cost about $8,000 a year per illegal who's here. That's what it costs the government, okay? Versus what they contribute to the government, okay?
Okay.
So they're a net loss, right? It's a bad deal. But the problem is the government runs the printing press, and the government can just create money out of thin air along with their unholy alliance with the central bank, the Federal Reserve.
Yep.
And we don't see the consequences of that money creation until much later. So initially, like if you take a snapshot in time, today, if you kick the illegals out, remember, most of them have a house they live in and they're mostly renting a low-end, cheap property. And their landlord is going to not be happy that they've been deported. They got to get a new tenant. And the wages of American workers are definitely suppressed by the illegals, okay? So the reason, you might say, well, what is the reason for decades this country has been so stupid and not controlled its borders? Well, the reason is because the inflationary pressures that the government creates by irresponsible spending and money creation. I mean, look, the more money you create, the more inflation you're going to have, because you've got an increased amount of currency, US dollars, chasing a limited supply of goods and services. So all the providers of the goods and services, obviously, when they see all this money coming at them, they're just going to raise their price, right? That's what anybody would do. It's logical. And so, with all of this, right, you deport and you ultimately see American workers get higher wages. That's a good thing. They want more money, right?
Yep.
But initially, there's a little bit of pain with this. So it's not going to be all rosy. Just understand, sometimes you got to take the medicine for the long-term good. And it looks like the Trump administration is going to make us do that.
Yeah, I love this. So, I mean, first we're talking about home prices and interest rates.
Did
Then
we
we
go
went
on a
into
tangent?
jobs. No,
Sorry.
this is great. Then we went into jobs, and then we went into what I was going to talk about was inflation and deflation,
Right.
right? Because we do have a huge government deficit here. We've been printing our way out of it, or trying to. We can't. We're going to have to cut a ton of government spending for the long term
Right.
good. Talk a little bit more about inflation and potentially deflation over the
Yeah.
years. What do you see happening, or what are your predictions there?
I see a lot of inflation. Another wild card that I didn't mention a moment ago is the Trump tariff threats.
Hmm.
I mean, look, just understand that a house is made just like a cake. It has ingredients, right? It has input costs of
Hmm.
construction materials. And if you look around a house, there are so many parts, right, to a house. I mean, think of all of the things that are imported from other countries. If you slap tariffs on those things, the price is going to go way up. Okay.
Yeah.
Think of the little things that are really easily imported: doorknobs, hinges, cabinetry, wire, electrical components, fuse boxes, right? There's just a million ingredients to a house. And if those items are tariffed,
Hmm.
initially it will cause prices to go way up. Ultimately, it'll create more American jobs. That's the idea, and more revenue for the government, instead of having, like Trump wants to eliminate income tax, another wild card. I mean, this is so impossible to figure out, right? There's so many unknowns right now. But ultimately, they're better. Like these things, everything he's doing is better long term. Just think of all these little parts. If there are tariffs on all these little parts, it's going to cause the price of construction to go way up, meaning home prices go up. So
Hmm.
many years ago, I started teaching a strategy called packaged commodities investing. I know
Okay.
that's a long one. I really don't love real estate that much. What I do love is the characteristics real estate has.
Okay.
So the first one is it's made of all these ingredients, all these commodities. And if you're a real estate investor, you already own all these commodities. Think of yourself really as a commodities investor. Now, normally, if you wanted to buy commodities, you'd have to go to the exchange, the commodities exchange, and you'd buy the commodities and you'd have to pay cash for them. And you would be somewhat of a speculator as to the prices of these commodities. But when you're a real estate investor, you get all the commodities packaged up in the form of a house or an apartment building. Okay.
Yep.
And you get to finance them with only about 20% down. The bank pays for 80% of them. You get a 3-decade-long fixed rate loan, which is unique in all the world. That's one of the things
Yeah.
you said earlier. And you've just got all of these awesome characteristics. You get tax benefits. If you just buy commodities, you don't get financing, you don't get tax benefits, and you don't get to rent them out to anybody else to have them pay the debt.
Yeah. Yeah.
So it is the ultimate, income property is the most historically proven asset class in the entire world. And so what do I think about inflation? I think there's lots of inflationary pressures, and I think we're going to see major inflation over the years. And there will be ups and downs along the way, but ultimately the trend is inflation. And you look at the government debt, we've got what, $36 trillion or so in debt, and you think, why would they be so irresponsible? They're not irresponsible necessarily. This is a plan. It is their business plan. And what I want to encourage everybody listening to do is follow the business plan of the government and the
Hmm.
Federal Reserve. and just ride on their coattails. I mean, look, philosophically, I hate what they're doing. I think it's wrong to go into all this debt and inflate away people's wealth and all of that stuff. I don't
Yeah.
like any of it. But practically speaking, I'm just going to follow their plan and benefit from it. So how can we benefit from it? I'll share my screen again. And what I created is a strategy where people can basically short the US dollar, which is a great item to short. In the long term, every fiat currency now, thankfully the world of crypto has taught a lot of people about this big scam. Before the crypto world evolved, people didn't really understand money, or they didn't know what fiat money was. What that fiat, the definition of that word, means by authority or by decree. In other words, the dollar has value because the government says it has value, right?
Yep.
And every currency on earth is a fiat currency. It's not really backed by anything. They used to be backed by gold, most of them, or silver, and now they're just an idea, basically. And so what do we want to do? We want to consider shorting the US dollar. Now, why do we want to do this? Because, this is Biden and Janet Yellen here in this picture, but it doesn't matter. It'll be the same way ultimately under Trump and under anybody. There can't be another way because of the dynamics we have. And they're spending, and government spending creates inflationary pressure. So then we look at what could the government do to get out of this mess? Well, the first thing they could do is they could say, look, we've made a lot of promises to our citizens, to foreign countries, and we're just going to break our promises. We're going to institute austerity measures. And if we look at what happened in Europe and other places around the world fairly recently, this does not go well. When you take away people's government benefits, they riot, okay? And they get out the pitchforks. So default is not a politically viable strategy. The next option is they could raise taxes. They could raise taxes and say, look, we're going to charge more tax so we can pay down the debt, or at least not have a deficit every year. The reality is you can't raise taxes enough to solve the problem. Now, we talked earlier, Dana, about the Trump idea of getting rid of income tax, which I think would be a phenomenal idea. I mean, there's a whole industry built on wasting our time and resources defending ourselves against our own government. It's just stupid, right?
Yeah.
Yeah. And I'm sure you agree. So instead of the IRS, what about the ERS? The IRS is the Internal Revenue Service, meaning we're getting revenue from our citizens. Well, the ERS is the External Revenue Service. Let's get money from foreign countries. And what Trump means by that is tariffs. And, I think the tariffs are a pretty good idea within reason. And so you can't raise taxes enough to solve the problem. There's just not enough money there. The US could have a yard sale. It could sell off assets. Remember years ago, we were going to sell the ports to Dubai. The Bureau of Land Management sells off land. And by the way, Trump is talking about doing that. But that's not going to solve the housing affordability problem. And I can go into that if you want. But, some of our toll roads are owned by foreign countries. We sell military equipment to a lot of people we really shouldn't sell it to because we shouldn't give them that technology. We could use the US military to steal assets of other countries, like going into Iraq and taking the oil, which we didn't really do, but everybody accused us of. On a good side, technological innovation. You have a tech company, and there's a lot of possibilities for biotechnology.
Grow your way out of it.
Yeah, to grow our way out of it. That would be wonderful. But the most likely plan of all is we're simply going to inflate our way out of it. And that's the best business plan. It really is the best business plan. So as investors, we want to do that too. And I can show you how.
Yes. And I love this. I love how you've broken this down and basically taken a really complex entire government strategy and just broken it down into 6 different ways they could solve this. And here's the best one. Talk to me a bit about the technique that you coined, inflation-induced debt destruction.
Yeah, absolutely. So this has been one of my claims to fame. And to understand inflation-induced debt destruction, I know it's a mouthful, and I actually trademarked that term years ago. because this strategy is like the hidden wealth creator that wealthy people have always used, even if they didn't know they were using it, right? It sometimes happens by accident. Most real estate investors, they think they make money because the property goes up in value or it produces positive cash flow. That's all great and it's all true usually, but that's elementary school. If we want to use a more advanced strategy, this is one of them. There are others, but this is really one of them. And to explain it, we first need to understand how monetary policy works and what it really is. So there are two big policies the government engages in along with the Federal Reserve, our central bank. One is fiscal policy, which is how much the government taxes and spends. This is mostly done by the House Ways and Means Committee, okay, in Congress. And so there's taxing and spending, that's fiscal policy. But on the other side is monetary policy. And this is involved more with the Treasury and the Federal Reserve. And what they do is they create money out of thin air. Money is lent into existence. You can go down a very deep rabbit hole on this, and I have many years ago. But just to simplify it, let's just look at a couple of concepts here. Okay, so to understand inflation, we need to distinguish between the real value of something and the nominal value, or between price and value. And so the word nominal just means in name only. That's the definition of nominal. And so if I held up a $100 bill and I said, hey, Dana, what is this? You'd say, what?
$100 bill.
Yeah.
$100.
And that's what I'd say now, or you'd say now. But what would you have said in 1980?
1980, I would have said that's a heck of a lot of money.
No, well,
a lot more.
Yeah. Well, you weren't even alive in 1980, I bet. But anyway.
1986.
Yeah, there you go. And so, maybe in 1996 when you were 10, okay, what would you have called it? You'd call it $100. The name hasn't changed.
Yep.
But
okay.
The value has definitely changed, right? It's lower than it used to be. It's just not worth as much anymore. So we need to understand that inflation is this insidious hidden tax that destroys our purchasing power. And it makes our stocks, our savings, our bonds, these investments we have, or even our equity in real estate, less valuable. It destroys the value of stocks, savings, bonds, equity, right? But thankfully, at the same time, it also destroys the value of debt. And this is why debt is my favorite four-letter word. Okay? So inflation is the most powerful method of wealth redistribution. Most people think taxation, like socialism or communism, redistributes wealth, and it does, but it's not nearly as powerful as inflation. And the reason is multifold, but one of the major reasons is that inflation is not understood by people. They just don't get it. They think, oh, well, last year the price of something was this and now it's higher. And that's true, but it's not really a deep understanding of what inflation is or how it works. So that's why I'm kind of explaining some of this. Now, here's the really important point. Inflation redistributes wealth from lenders to borrowers. And it also redistributes wealth from old people to young people. Maybe you want to chime in with any of your thoughts about why this might be true. Feel free, or I can just keep going.
No, I think it's a great point. I mean, redistributing it from lenders to borrowers, you're almost rewarded if you're borrowing, right? Because that debt over time becomes less valuable, or how much you have to pay.
Right.
And then from the old to the young, if you're younger, if you're old and let's just say you keep that $100, it's suddenly in value. The real value goes down over time. And so when you're young, it's almost rewarded that from that perspective, you're making more for the same position that someone older 20 years ago was making a lot less. So I love this, breaking it down this way.
Yeah. And so just to elaborate on that a little bit more, mostly old people have these things. Hopefully they do: savings, stocks, bonds, and equity in real estate. And mostly young people have a lot of debt.
Okay. Yeah.
So usually you think of a wealth transfer as an inheritance, okay? And that's one way. But what's really happening is through inflation, wealth is being redistributed from old people to young people every second of every day.
Hmm.
Okay. And I know young people are complaining like crazy right now because, they complain they can't afford a house, they've got big student loan debt. That's another topic, and we can certainly talk about that. They're partially right, but they're not completely right. And I'm happy to explain that. But just to understand inflation-induced debt destruction a little bit more, this is my trademark strategy, and it has been very well received because most people do not realize what is going on behind the scenes. I mean, think of it, Dana, like this, like an iceberg. Only a little bit of the iceberg is above the water, most of it's below the water. And
Hmm.
in the real estate world, what's above the water is appreciation and positive cash flow. Those are things people notice. But what's below the water is bigger. The bigger portion of the iceberg is below the water. Inflation-induced debt destruction, tax benefits, tenant paying down the mortgage, all of these other things, but especially this one is so, so powerful. So here's an example of how powerful it is, okay? Now, there's a whole lot of numbers on this chart, but you don't need to think about all of them. I'll just point some out. So let's go back in history to 1972. That was 1 year after Nixon took us off the gold standard. And the median house price in 1972 was just over $18,000. And if you put 20% down on this house, and this is the green part at the top of my screen, if you put 20% down, you would have a mortgage for just over $14,000, okay? The interest rate back then was 7.37%. Do you all see how interest rates really aren't that high nowadays? We just got extremely spoiled during the COVID era. That's
Yeah.
not normal, okay?
Exactly.
Yeah. And so you got a 30-year loan. Now, this is not a theory. This happened to tens of millions of people. Around the world, they didn't have the great loans that we get in America because post-World War II, the mortgage industry became subsidized by the government. So if any of you people who are middle class or upper middle class or wealthy are upset about all your tax dollars going to pay welfare payments, well, here's some welfare for you, okay? You can get some government welfare right here with this plan. And so here's what happened to these tens of millions of people, right? We'll go in the first row here, 1972. The inflation rate was 3.2%. And in 1972, a dollar was worth a dollar because no inflation happened yet, right? We're just starting. And the annual payments on this typical house were $1,211 per year, or $101 per month, all right? Now, let's fast forward to 1984, just before you were born. George Orwell wrote a famous book that everybody should read called 1984. You got to read that book because it's coming true, sadly. So now this 1972 dollar we borrowed is only worth 40 cents. Okay? And we keep writing checks. The tens of millions of people kept writing checks for $101 per month because that's what the mortgage payment was.
Payments, yeah.
But that monthly mortgage payment of $101 felt much, much lighter 12 years later. In fact, it only felt like $41 because inflation had debased the amount of the monthly payment, but also of the loan balance. It does it in two ways, okay? It's an incredibly powerful tool. So then let's go to the end of this mortgage. So 30 years later, that dollar we borrowed is only worth 24 cents. And that $101 that we're paying every month as our mortgage payment is only $24 now due to the magic of inflation. Okay? Now, inflation hurts most people, but it helps people who own assets with debt against them. Okay? That's who inflation helps. And that's why the people owning real estate, and especially income producing real estate, just pass everybody else in the race to financial freedom. So just to review and recap here, remember, we borrowed just over $14,000. And you know how when you sign your loan docs, if you bought a property, there are these government required squares at the top. I think there are 3 of them. And one shows the total amount of all the payments you're going to make over 30 years. So in this case, these people paid over $36,000 in payments based on their 7.37% mortgage that they borrowed. But after inflation-induced debt destruction, the real value of this $36,000 they repaid for 30 years was just over only $16,000. So if you calculate the interest rate, they really only paid 1.06% interest, not what they thought they were paying of 7.37%. Now, you know the dumbest mistake? There were a lot of people in this situation in the 70s, 80s, 90s, 2000s, 2010s, right? It just keeps on happening, who paid off their mortgages because they listened to Dave Ramsey. And they lost this benefit. The mortgage is truly an asset. It's not a liability, okay? And so remember that mortgage interest is tax deductible. So after inflation-induced debt destruction and tax benefits, you really only repaid $12,655, but you borrowed $14,600. So you had a negative interest rate of negative 1.16%. You literally got paid to borrow this money. But wait, there's more, as they say on those late night infomercials. But wait, there's more. You also got to live in this house for free. You got paid to live there for 30 years.
Yeah.
Okay. Now, this example, Dana, is based on an owner-occupied house. But if this is an investment property, the tenant is paying the mortgage for us.
For you. Yeah.
And giving us a little extra every month in the form of positive cash flow. And we get an even better tax benefit than mortgage interest deduction on investment properties. We get what's called depreciation, which is the best tax deal ever. Because basically what it allows us to do is depreciate the value of the property. And even though the property is appreciating in value, the IRS will allow us to say it's depreciating. It's the best deal ever. Okay, so not only is income property the most historically proven asset class in the entire world, it is also the most tax-favored asset class in America. And taxes are the biggest expense of almost every American. So if we can save on taxes, we are also getting ahead dramatically compared to everybody else.
Jason, if this did not convince someone to go out and buy real estate right now, I would be shocked if that person makes any money in the future, because this was broken down so eloquently. And also just, it gets me more excited about real estate. And even that example, 7%, just where we are today, and looking at it through time. What do you think? There's always this rent versus buy. And I think majority of Americans do not understand this, if not 98, 99%. With home prices where they are, and people saying home prices are high, and then mortgage rates are elevated just because we got spoiled, between 2010 and through the COVID years. What do you think will happen? Do you think there will be a long-term shift of more people renting? I think it's, 37% of US households are renter occupied. Do you think that will increase, or where do you think the overall US market is going?
When we look at the rent versus buy analysis, the first thing I want to say is that it depends on the value of the home. And here's why. Another strategy I started teaching 21 years ago is the RTV, right? The rent to value ratio, okay? And on a low priced home, the rent to value ratio is in favor of the owner. On a high-priced home, the rent-to-value ratio is in favor of the tenant. Because what happens, if you're kind of thinking of this like a chart, is, the rent you pay will go up as the value of the home increases, but the price could go up a lot more. And so there's this big delta between the two. And so what we want to do, ideally, is we want to own a lot of low-priced entry-level properties that we rent to other people, because in that case, the rent to value ratio is in our favor as the owner and the
Yep.
investor. But if we have some means and some money, we would ideally want to rent a high-end home for ourselves. Because on the high-end home, the price could be, $3 million, but the rent is likely to be only a little bit more. Okay.
Yep.
So let me give you a real example of that in terms of real numbers. Okay. As an investor, ideally, we want to get as close to 1% of the value of the property per month as our rental income. So the
Mhm.
example would be if the property is $300,000, which it's so funny to say that because, 21 years ago when I started working in just the investor world and selling properties to investors nationwide through our company, you could, buy these houses for $70,000, $120,000 all the time. Now the same house is 300,000, right? So, there's another reason to invest in real estate. Okay. That was only a short 21 years ago, and I
Yeah.
remember it well. These little entry-level properties, which make the great rentals, if it's 300,000, you want to get as close to $3,000 per month as you can. Now, look, for good quality properties, you can't do that today. You might get like 2,500, okay, which,
Yeah.
you get as close as you can to 1% per month. But think of it this way. You could rent a $2 million house in any major city in America or the world, by the way. These ratios, by the way, interestingly hold up all around the world. And that $2 million property, you could rent that for like 0.5 or 0.4 of the value. You might rent it for like $8,000 a month. Okay.
Yeah.
And it's just so beneficial for you as a tenant to rent a high-end property and own a lot of low-end properties to rent to other people. So you're kind of arbitraging the rent to value ratio. Okay.
Yep. I love that. I love the arbitrage there because it's true. There's, especially with those who have money, this almost stigma and negative association with renting. And some of the smartest people I know
Yeah.
do not want to buy their primary residence where
Right.
they're living, but they do invest in real estate
Yeah.
elsewhere.
Absolutely. Absolutely. So own real estate. We're definitely in favor of that. But it
Yeah.
doesn't have to be the house in which you live. Okay. Now, Dana, one thing, I mean, people are funny, it's been said that we make decisions with emotion, rationalize them with logic, right? We're just all human. Okay. So of course we do that. But think about it. A lot of like, you could have this debate with most people and they'd say, well, I'm not going to throw my money away and give it to a landlord. Why would I do
Yeah.
that? You're paying to live somewhere anyway. That's just an expense of life, right?
Yeah.
It's like having a car. You're going to pay to have a car. You're going to pay to have anything you want to buy, right? And so we're all, in the final analysis, we're all just renting everything. You're not taking any of this
Yeah.
with you, okay? So, yeah. So it's don't have a stigma about renting your own home. As long
Yeah.
as long as it's a home that's maybe in today's market, I kind of have to adjust my prices. If that home is the current value of it is above $500,000 or $600,000, you're going to start to be better off renting in terms of rent to value ratio. And if
Yep.
it's below that, you're going to be better off owning. Okay. So if you're living in a cheap house, own it. If you're living in an expensive house, rent it.
Yeah. Remember that, everyone. Rule of thumb there,
Yeah.
500, 600,000.
Yeah. And that'll adjust with inflation, of course.
Inflation. Yeah, totally. I want to move over to totally different topic. One thing that impresses me is how much of a visionary you are. And not just in real estate, but in tech and other companies. Walk me through just one of the most exciting things that you're thinking about or working on, and how you do it, how you have all of these creative, incredible ideas and still manage to have the economics, the foundation and structure for investing in real estate.
Yeah, so first of all, thank you for the compliment. I mean, I'm quite impressed with you too, Dana. I mean, you know the tech world inside and out, and the finance world as well. It's just pretty incredible. So we all have ideas for a gadget, a gizmo, a software. We've all had these ideas, right? And then you go out and you don't do anything about it most of the time. Most of it's just it's an idea and it comes and goes, and then 6 months later, you see that that's in the marketplace and someone invented it. So one idea that I had years ago that I know I told you about recently is a travel coat that is actually a piece of luggage. And I got this idea years ago because I was going skiing in Whistler, and I lived in at the time in La Jolla, California, San Diego area. And I really don't like checking a bag because they lose my bags all the time, or they're not, maybe not lost forever, but they're delayed, right? And it's just
Hmm.
the airlines, they're terrible, okay? And I just really don't like checking a bag. I like to get on the plane and get off the plane. I don't want to show up early to check a bag in and have them lose it or anything. I just want to go. And so I thought, now I got to take my ski clothes. How am I going to pack with my regular clothes plus my ski clothes? And I was going to go on like a week. They won't fit in my carry-on. So I decided I'll just wear my powder jacket on the plane. And a powder jacket when skiing, it has all these pockets in it, right? So
Yeah.
you can put your gloves, your goggles, everything, right? And so I just stuffed all my ski clothing into my powder jacket. I looked kind of geeky and stupid, but I did that. And then I was carrying my ski helmet in my hand. And the rather rude gate agent, of course, said, "Well, you have to check your helmet." And I said, "I'll just wear it. You're allowed to wear a hat on a plane."
Yeah.
Okay, right? And I'm scared of flying. No, I'm really not. But look, I'm afraid of flying. I want to wear a helmet. Okay. And so I wore my helmet to get on the plane. Of course, I looked like a complete dork, and I put it in the overhead when I got on. So I thought, why isn't there a coat that would allow you to pack some of your clothing in the coat? So I
Yeah.
created this really nice looking, very fashionable coat that I filed a patent on. It's a patent pending design, and it's got a lot of little unique features to it. And I'm waiting for version 2 to come out before we finalize and start production on it. And it's a travel coat, and you can carry a lot of your clothing in it so that you can bring more stuff and not have to check it. I mean, the
I love.
airlines look, you know what one of my friends said? He said, the airlines are going to discover that people are doing this after your coat gets famous, and they're going to make a rule against it, and say you can't do it. What are they supposed to say? You can't put stuff in your pockets? I mean, is that
Yeah.
going to be the rule? Like, that's all it is pockets. Yeah.
Yeah, definitely. I love this so much because I also hate checking bags
Yeah.
and try to make sure I'm the one on the plane so they don't have to check my bag and all of that. But if folks wanted to reach out to you to learn more and get on your list to purchase the coat, as well as just to learn more about, you have an incredible YouTube channel, a podcast as well, with so much a wealth of information about investing and how to become successful. Where would they reach you?
Yeah, so my main website is jasonhartman.com. It's just my name, JASONHARTMAN.com. And of course, you can type my name in YouTube or any podcast platform and find my podcast, my YouTube channel. I'm on all the usual social media. Instagram has really kind of grown to be a bigger thing. And on Instagram, I'm Jason Hartman and the number 1 because I couldn't get my name. So Jason Hartman 1 on Instagram, and you can find me on all the social networks as well.
Fantastic. Well, for those of you listeners who do not know with jasonhartman.com what you can do, he also helps you invest in real estate. We've personally worked with a ton of investors who are completely and utterly satisfied, saying it was their best decision to invest with Jason. So please go ahead, check out jasonhartman.com. You can purchase properties, again, that rule of things under 500,000, which are going to be incredible investments for you. Go ahead and check out jasonhartman.com. Also go ahead and listen to his YouTube and podcast and let us know if you want early access to that jacket.
Happy investing. Thanks, Dana.